This is the Collecting Real Estate Podcast. I'm your host, Stephen Purse, here with your co-host, Bill Hamill.
I'm somewhat more comfortable collecting real estate than I am collecting other stuff.
This is the Collecting Real Estate Podcast. I'm your host, Stephen Purse, here with your co-host, as always, Bill Hamill. This morning we interviewed Ryan Tanel with Top Producer Investment Capital. Ryan had a lot of great things to talk about, from when he first started in real estate in the Austin, Texas market to closing on 5 syndications this past year. Bill, what'd you think?
No, it's great. I love his journey because he went from the film business to the mortgage business and then the real estate investing business. And he's been able to make those segues seamlessly and stay focused on what he really needs to focus on to be successful.
Yeah, he's a great networker, and he has an ability to have a vision and find good risk and execute on that vision. A lot of good points today. Here this morning with Ryan Tanel from Top Producer Investment Capital. Excited for this episode. I met Ryan out at MM5, a real estate networking event in Orlando, Florida. And excited to hear more about Ryan's story. Very impressed. First time I met him. Ryan, let's get right into it. Tell us how you started collecting real estate.
Yeah. Hey guys, thanks for having me on. So, I've actually been fascinated with real estate for a long time. So when I was going through high school and college, originally I wanted to be in video editing, visual effects. I thought it was really cool to play on Photoshop and Final Cut Pro and kind of create a world and tell a story. And I still have a passion for that, but the reality of working day to day doing video production is pretty grueling for those that have actually done it. So I read, I did that for 3 years, and I read Rich Dad Poor Dad, and it really turned my world around to see the possibilities of what's out there, not only with financial freedom, but time freedom and working on projects that you can get behind and having a work-life balance where you're working with the people that you enjoy working with every day. So I read that when I was 23. I wish I had read it much younger, but luckily it changed my outsight at that point. And just read every other real estate book that I could get my hands on, every other finance book, and just kind of took the plunge to leave my job doing video editing and moved to Austin, Texas here. And, I probably spent 2 months without a job, without an income. And I just interviewed, anyone that I could think of that would work in the industry and say, hey, if you know any ways to kind of get in, I'd love to learn how to do this, specifically from the investment side. But, they say in Rich Dad Poor Dad, you got to work in the industry that you want to be good at before you can, own your own business doing it. So I got a job doing mortgage lending, which worked out well. I have a bit more of a finance and math logic mindset, so that played real well in my skill set. So I was doing residential mortgage loans for 7 years with a company. Luckily, I got paired up with a great mentor. This guy, Steve, worked at the company, and he owned about 30 single-family homes up in Dallas. So in addition to teaching me the mortgage business inside and out, he showed me how to buy properties right, how to invest in them, and how to have the right mindset so that they're cash flowing and so that your risk is low and so that you're managing expectations of tenants and, everyone along the way. So, I spent 4 or 5 years doing the mortgage before I was able to buy my first investment property. And I did the FHA house hack with a duplex. And then I moved out of that into a single family house and, grew that. And then, I liked the house that I was living in. So I said, let me see if I can figure out how to do this discounted wholesale purchase real estate thing. So I tried doing that. I got 2 properties that way with a deep discount. But the trouble was, all along the way, I was making good money as a loan officer, and it was a bit of a distraction to build a pipeline to find cheap single family real estate. And even once I found it, then you're negotiating with the seller, then you're having a property manager, you're managing renovation crews. It was good effort, but it took me away from doing mortgage lending, which is a pretty demanding job, and it's a pretty rewarding job financially. And so I just knew psychologically, the more effort that I could put into being a loan officer and making a lot of money, the better I was, like, that would be my better financial outcome. And if I could find a way to invest passively, that would be great. But the trouble is, there's no really good investment deals that are out there that are truly passive. You're buying something off the MLS, or, you're getting in a syndication or something else like that. I didn't even know what syndications were at the time. So kind of fast forward to getting into the multifamily space. I knew I eventually wanted to be a full-time investor. Mortgage, it was lucrative, but it is a grind. I don't know if you know anybody that's Worked as a loan officer for a long time, but it is, constant 50, 60-hour weeks and clients every day calling you with demands, and everyone's emotional because their house is on the line about not getting purchased. So it's a pretty frantic business to work in. And so, I decided to get out of that once I learned how syndications work and how you can pool investor capital all together to buy one commercial property at, multifamily apartments. And then I looked at some of the underwriting spreadsheets. They made sense to me. I talked to the people that were doing it long term, and I saw the payouts that general partners and even limited partners were making in these deals. And I said, yeah, this makes much more sense than what I was doing. And once again, it was a bit of a hurdle to step back and quit my mortgage job even before I had any multifamily. But I just knew that was a direction I eventually wanted to go in, and I had faith and trusted myself that I'd figure out along the way. And so, I ended up quitting my loan officer job in April of 2021, and I spent an entire year, trying to get a deal, trying to find partnerships, joining the Jake and Gino team, and they kind of helped me along the way. And eventually, through partnerships with Jake and Gino, I got my first deal in April of 2022, and it's been a bit of a snowball. We ended up closing on 5 deals this year.
Okay, fantastic story. Love that. Great having you on this morning. We're in New York and you're in Texas. That's one of the beautiful things about these podcasts and a lot of the mentorship groups we get involved in. We meet so many people nationwide and a lot of cases worldwide. I appreciate how you made a big pivot, huge decision to go from what you went to school for, video editing, right into the mortgage business, found that mentor. What I'm curious about is you were in the mortgage business for 4 or 5 years, had that mentor, but you hadn't done that deal yet. What was your mindset for those first 3 or 4 years? I know you have to build up, get into a position to do that first deal, but why did it take 3 or 4 years for you to jump into that first investment?
Yeah. So coming from a background that has 0 real estate experience, it was a big learning curve. So the first 2 years, I was just feeling comfortable in the industry. Even though I'd read a lot of books and understood how everything works, I was like getting myself comfortable with pulling the trigger because, to me, buying a house that's $200,000, well, $200,000 is more money than I ever had. And, I know there's loans and all that stuff, but that's a big risk mentally, a big hurdle to kind of get into. So I was kind of getting over that. And then the other thing is, I had student loans, and, when I was the first couple of years of my mortgage career, I was making, decent money, but it wasn't a ton. So I had to pay off my student loans and have, kind of living expenses covered, and then build up enough of a nest egg where I'm like, okay, now I have my down payment and I've got a little reserve contingency. So once I finally did have that, I did make the plunge and buy that first property. But yeah, it took a little while to get there.
Yeah, that Austin market's not cheap for a first property. We have another rich dad, poor dad prodigy here.
Absolutely.
Yeah, everybody knows Rich Dad, Poor Dad for sure.
Yep. But there's a lot of 23-year-olds that read it and want to invest in real estate, but don't take that first step. And it seems like you have that willingness to take that risk, moving to a new city, trying out something new, and then you do it again recently to transition full time into real estate. Is that something that you have found has helped you so far in real estate investing, that willingness to be able to take risk?
Yeah, absolutely. I mean, all of investing is risk evaluation. And so it's just understanding everything that you're getting into and then just deciding it's the right thing to do, even if you don't have all the information out there. So I'm a pretty conservative guy. I'm pretty reserved in the sense that I like to learn everything I can about something, but at some point, every new book that I pick up, I'm like, they start saying the same things. I'm like, there's nothing new that I'm going to learn from this one interview or this one book. I just need to, make the decision. Hopefully you have a mentor or someone along the way that, hey, you can, bounce ideas off them and they'll steer you from making a huge mistake. But yeah, eventually, Warren Buffett's big at saying the biggest risk that you can take is not investing at all or not investing in yourself. And so I'd much rather have taken the risk, failed, learned along the way and figured it out than to just kind of like passively overanalyze and never actually do anything.
Absolutely.
Yeah, without a doubt. I love that you're in that mortgage business and now that mentor brought you along and you're probably watching some of your clients make money as you're writing mortgages. Tell me what your mindset was there as you're seeing people's success and you probably wanting to get into the game. What type of portfolio did you build up on those smaller properties as you were a mortgage originator?
Yeah, that's a good point, actually. And that's one of the reasons I'm forming the top producer investment capital group that I've got now, is because I would, I would work with wholesalers and other investors, and we would do conventional loans. So they would buy something super cheap, they would renovate it. And if they wanted to keep it, we would do a conventional refinance for them, and they would be able to cash out and pull their money back. And it was exciting for me to see that, hey, here's the possibility of somebody that really bought something at a good price, really did the budgeted work that they were going to do, and now here's the equity that's really appraised and they're pulling out. So it was exciting to see that. And then it was just frustrating as a loan officer where I was like, man, I'm not able to really tap into that because I have a job that I have to do every single day. And, I could kind of do it on evenings and weekends, but it wouldn't really be the same pipeline and scale. So I said, I've just got to be a part of this. But yeah, it was nice and encouraging to see that, hey, it's out there and other people are doing this. The loans that we would do would be single family. So we had a couple of clients. Most clients that were investors would have 4, 5, 6 single family homes. I think we had 2 or 3 that ended up having a portfolio of like 30 or 40 single family homes. So it was inspiring to hear their stories, because most of the time it only took them like 6, 7, 8 years of, just actively doing it full time to build up a nice portfolio. And then they all become, multimillionaires. And, one of them would tell me, yeah, I get up around 9, I have a nice workout, I have lunch with my girlfriends, and I spend 2 hours checking on my real estate, making sure everything's okay, maybe doing another deal. And I was like, oh, what a life.
Yeah, it's so simple, Stephen, isn't it? When we first get started and we're talking about all of these investments and how easy it's going, it's just rocking and rolling right off the rip, right?
That's what you hear at those conferences. You can just get a cash out refi, no problem, like Ryan said. And the best part is it's tax free.
Mm-hmm.
So I met Ryan about a month ago at MM5, like we said, Orlando, Florida. And what stuck with me was your story on this short-term rental property. I think it's just outside of the Austin market. Very unique situation with this property. Tell us more about that.
Yeah, absolutely. So this is the second deal I've ever closed. It's my favorite project by far because there's a lot of creativity and a lot of excitement that goes into it. So since I've been living in Austin, once a year I'll gather a group of 10 or 15 friends, and we'll usually go rent an Airbnb out in this lake called Canyon Lake. It's about an hour outside of Austin. And the significance is it's just far enough away from the city that you feel like you're in nature. There's a lot of trees, there's some nice landscape, and there's a nice lake over there. And we can kind of be rowdy and have fun and, have a wonderful weekend and then come back to Austin. It's a little bit of an escape for nature. And I've always thought, man, that would be so cool to run something like this. Because each time I would visit one of these houses that were Airbnbs, they were cool. They had a lot of features that I liked, but I had a vision for something that would be great. Man, if it could just have this and this and this and all these other amenities, they could, charge way more. Everyone would have a great experience. It could basically be like a summer camp for adults. And so, even though we're doing this multifamily investing, and usually I look for apartments in the back of my head, I said, man, that'd be really cool if I found an opportunity to kind of make this passion project or this dream came true. And so just as it is, we're out there networking with brokers, making our phone calls, making offers. This one broker had sent me this deal, and he didn't even know that I specifically wanted a project like this, but he'd called me. He says, hey, Ryan, there's these 14 units out in Canyon Lake. They're, technically manufactured homes, but it seems right up your alley. It definitely needs some renovation, some improvement, and then you can, turn it into a better property. And it was already renting out for $1,400 a month. And so he was like, yeah, you could probably get $1,700, $1,800 a month, if you make them look nice, which is true. But, I went over there and immediately I saw, oh, man, this is the vision. It's 5 acres. They've got 14 of these cabins. It definitely is really messy. It needs a lot of work, but this is a perfect setup for what I had in mind. So luckily I go over there and I pitch my story of, hey, here's everything that I'm planning to do with the property. I'm so excited to buy this. I've got this vision. I've been doing this business for a while. We've got the capital lined up. We've got the partners all lined up and really selling it to the broker. And I feel like that's the reason that we won it, because it was originally listed for 2.1 million. And, to be honest, like I always love getting a deal and you never want to overpay. But because of the profit that we were going to make as a short-term rental, the price that we bought it for wasn't as big of an important factor as how well we run it. So we ended up negotiating them down to 1.875. And the broker was telling me along the way, he's like, hey, we've actually gotten other offers that are slightly higher from better groups out of New York and California. But I'm telling the seller to go with you because you're here, you're local, you have the passion, you see it. These other guys are going to, back out last minute or retrade or have all these other problems along the way. They're not going to get it. They're not going to see it the way that you see it. So we actually got it, we weren't the highest offer, but they ended up going with us. And it was a great process. It was my second raise. We had to raise $1 million for the down payment and the capex on that one. We got a loan with 80% loan to cost. So we bought it for 1.875. We're putting, 1.1 million of capex into it. So we're about 3 million all in, but even on a 9 cap, once we get the pro forma going, year 3, it should appraise at about 5.5 million. So there's plenty of equity there, but all of it is in how you run it. So we bought this at about, I think it was like a 5.5 cap when we bought it. And a lot of multifamily in Austin and Texas trades between, 4 and 5 caps, and I mean, with where we are in the market, I'm typically underwriting a little higher than that, maybe 5.5 cap, but short-term rental and these hospitality space, especially a unique play that's not like a hotel, that's not like a house, it's like its own little contained thing. I have a hard time underwriting an exit cap rate. So we're mostly doing this to pro forma. We're going to carry this for 10 years. But we're going through and, so if we do it out for 14 units, we paid about 137 a unit for these. We're putting 40,000 per unit on the interiors. We're putting about 600,000 to the entire exterior. We're installing a pool. We're installing grills and kitchenettes and shade structures and, amenities like ping pong tables and, cornhole and all the other kind of games and things that you can do that are fun. And the idea is you'll come and stay for the long weekend. We're hoping to get $300 a night. We're going to have our own website set up so that people can book directly with us or through Vrbo or Airbnb. And then they come and stay, and we'll make it a little community where people can get to know their neighbors, play games, have fun in the pool, relax. And we're actually going to be one of the cheaper short-term rentals out there because most of the community or most of the houses out there are these bigger mansions that cost $500,000-$600,000 for something that's 3-bed, 2-bath, which is what we are, that hold 8 people, that have the amenities that we're going to have. You'd pay $500 a night for like this big expensive house, and we're coming in at a cost basis of $200,000 a unit, and we're only charging $300 a night to hit our pro forma. And we're only expected to be to hit our pro forma numbers is occupied for 40% of the year, when there's some comparables out there that are rented 70% of the year. And even AirDNA is saying we should expect 50% of the year on average. And we hope to be above average because, I'm going to put a lot of energy and effort to making sure we max out every result. So I think it's going to be a fantastic project. I love it because in addition to making, above size returns for our investors, it's going to be fun. Anyone that is an investor can come and stay and use the cabins for free. And, I think it's something that really makes the community better and has like a nice, way to go about life. And yeah, we get a little enjoyment out of it.
Wow, that sounds like fun. There's a lot to unpack there. I love that innovation, being able to take that property and change the use into a short-term rental, that hybrid approach, I guess you can say. You have multifamily being 14 units, and then that vision of turning it into short-term rental, adding all those amenities. We talked about that on that last episode with Steven's pal there from Tampa on the short-term rental stuff. I know you mentioned that you got a 80% loan to cost. Mm-hmm. Was this from a local bank? Were you able to share your business plan with them? Because I know banks sometimes are a little reluctant on that short-term model. What was that discussion like?
Yeah, this is, I nerd on this because coming from the mortgage background, to me, the loan is one of the most exciting parts of the process. But of course, it's not the really exciting part for everyone else. But yeah, so usually what happens is you'll call like a loan broker and they charge you like 1 discount point to pair you with a bank. And then that bank will charge you 1 discount point. And then you kind of get whatever terms, and the loan broker, puts it together. And they have their best intentions, but a loan broker's got like a lot of clients. So, they're going to pair you with what they think makes sense or what they know. But not every loan broker knows every option. Of course, neither do we. And, it's really impossible to know because there's so many local banks. So this one, it had a lot of challenges from a financing standpoint. For the first, it's, 1.8 million. So it's kind of a small loan that we're purchasing. I think we needed, between 1 and 1.5 million, just initial loan amount. Plus we wanted a lot of renovations in there. We also, we're turning in short-term rentals. So a lot of banks have a problem with that. It was also manufactured double wides. So a lot of banks have a problem with that as opposed to, stick built slab foundation properties. So there were a lot of things to do. And so essentially what I did, I've got a list of probably 40 lenders that I've just, hey, anytime I've met somebody that's a lender, a local credit union or bank, I put them on the spreadsheet. And the more I know, the more that list grows. And essentially, when I get a deal, I've kind of learned, hey, these lenders like these types of products or these types of opportunities. And I just went through the list and called every single lender that I knew and say, hey, here's everything about the project. Tell me if you have an appetite for this. Tell me if you're interested in this. And I mean, out of the 40 I called, I think 37 of them just said no. And I only had 3 of them that were even interested in, giving me an offer. The first one was, really expensive. The interest rate was like 8%. The next one, they wanted like 40% down. So it would have been a good deal, but we ended up pairing with the one with Security State Bank and Trust out here. They have a local branch in Canyon Lake that's like 5 minutes from the property. So she was like, oh yeah, I know that one. And so she's like, yeah, I get it. I get what you're doing. We do. They specialize in construction loans in general. So they just treat this like a construction project. And they're like, yeah, you go out there and do whatever you need to do. And what I've learned is that, as a bank, when you're underwriting a potential deal, a bank is always going to be more conservative than the buyer because they're going to assume that the buyer is not going to be able to perform as well. So as a buyer, to really sell something to a bank, you got to beef your numbers up because you just got to know that they're going to tear them down anyways. Now, the reverse is true when you're talking to an investor. You want to be conservative. You want to say, hey, hopefully we outperform these numbers. I would expect these returns. Hopefully we get better for you. But when you're talking to a bank, you want to do the reverse. You want to sell them the moon and say, hey, we're going to, make $1 million a day on this project, something within reason. But I basically take my underwriting and I beef it up 15%. And then that's what I send to the banks to say, hey, I think we can hit these numbers. And then when they back it off 5 or 10%, still looks like a pretty good deal, and it makes it a lot easier to get financing. I think a lot of partners have trouble because they give the bank their conservative underwriting, the bank backs it off further, and then it doesn't hit their DSCR numbers or whatever else. So that's a little trick to get any kind of financing you need.
Ryan, you had me at adult summer camp. It
Yep.
sounds like such a fun project. And similar to when you moved to Austin, you had a vision, you were able to execute on that. You mentioned having 5 syndications this past year. Were the other 4 more traditional multifamily syndications?
You're correct. Yeah, all the other ones have been multifamily apartments. So my first one, 32 units in Gonzales, Texas, came about from a wholesaler and a partner through Jake and Gino. We quickly put a GP team together. I ended up, it was my first deal, but I had been grooming a couple potential passive investors to say, hey, when I find a deal, are you ready to go? And luckily, the first phone call I make was a guy that, ended up funding the whole thing. We needed to raise $400,000. And he just said, I actually just sold some property. I've got $400,000. Like, here you go. Let me do this deal with you. You're going to make more money than I would do with the stock market or my other investments. So let's do it. Then we closed on the Canyon Lake 14 units. And then we did a 40 unit in Austin with a syndication. And then we did a 75 unit in San Antonio with 7 partners. And then me and my dad, just personally, I 1031 and sold one of my duplexes from a long time. The first duplex I ever bought, actually, just sold that to 1031 into this 12 unit. And so me and my dad are the only 2 owners on that one. And that's a fun project because I'm taking the lead and managing the contractors. And, we got it at a phenomenal cost basis. So, it's pretty low risk and it's fun to just kind of work on a project together with my father.
Awesome. Going back to that first one that you purchased, because I listened to you on another podcast and we all talk about that power of networking and teams and so forth. Tell us about that first deal. I think you had what you were calling the cowboy cohorts. How that first deal came along, because without that small networking team, that deal wouldn't have come about for you.
Yeah. Well, I'll tell you, the story is, starting your own business, doing this investing firm and starting in multifamily, even though I had 7 years experience as a loan officer and owned my own property and had a lot of connections working in real estate, it's a pretty lonely business because every day you got to get up and give yourself a little pep talk to be like, all right, I'm going to make these calls, I'm going to do this outreach. Even if you're part of a networking community, it's really up to you every day to put the action in to get the results. And so what's been great about the Jake and Gino community is everyone that is in Texas, from Dallas, Houston, Austin, and San Antonio, we all got together at these conferences and we say, hey, we need a way to stay in touch. We need a way to speed this process up, because if each one of us is taking the time to learn how to underwrite a deal and learn how to tour and learn how to do all of this stuff, it's going to take forever. If we can just put 10 of us in a pod And we've got like a little Slack channel that we, trade notes on. And then we have a Zoom call once a week where we get on there and we say, hey, what did everybody do this week? Who looked at a property? Who underwrote? Who toured? What's the price per door we're seeing? What are the rent comps we're seeing in each of these markets? And it was a much more accelerated way to learn because you have so many people at varying skill levels and varying specialties able to contribute to the conversation. And it didn't feel like you're all alone. And so when I find a deal, I'm like, hey, I think this is a good deal. Here's my underwriting, here's my feedback. Someone, we've got a couple people that have 500 to 1,000 units in that pod that can come in and say, hey, I like where your head's at. Have you considered, this, and this? And then that gives me the confidence to go and say, well, no, I haven't. Let me go consider those and let's reevaluate if this is a good deal. And if it is a good deal, you already have a general partnership team formed where you're saying, great, well, I can bring, I brought the deal, or I can bring the underwriting, or I can bring some capital, or I can manage the asset as boots on the ground. Like, who wants to play different roles? And then you're like, okay, great. We've got the general partnership team set. Let's send out that LOI. Let's be a force that's much greater than any one of us could be individually. So it's been extremely helpful in, learning, growing, and the ability to do deals, and just the confidence in the whole business.
Yeah, multifamily commercial real estate's a team sport.
It seems like it's a mini mastermind, what that was. And you got that first deal done. Have you been able to develop consistency with the team on that first one, or do you seem to be going from deal to deal, more of a transactional basis? I know you mentioned you're in a 1031 on that new property with your father.
Mm-hmm. Yeah. So now that I've been in this business, it's been 2 years now that I've been full time, and the Jake and Gino community has really helped develop me. I've gotten a lot more partnerships, and it takes a long time to build, trusting partnerships, because you've got to work with people for a long time to know that you can count on them, that you can trust in them. And it's always finding the dynamics of what skills that I have that another partner has that would work well together, and finding people that you can count on, that you can trust, that are in the same space as you. So it takes a long time, and I feel like I'm still building a lot of those partnerships. So to answer your question, yeah, the community has been there, and we've continued to work on deals together, and it's grown. But I've been able to narrow a little bit of my focus on who I enjoy working with the most, who the partners are that I really want to continue and maximize. And to be honest, I think a good team is maybe 4 or 5 general partners that kind of have their buy criteria, that have their contractor set, that have their financing lined up, that can have a deal come across their plate and very quickly say yes or no, execute on an LOI or on a contract, put it in the pipeline, and then just kind of go through the process of the renovation. So you're not having to build a whole new plane every single time a deal comes across and figure out who's going to be a good general partner for this. So it's a journey that I'm still on, and I'd love to figure that out in the next year or two, is saying, let's get a solid group of 4 or 5 general partners that we all know how each other works. We all know everyone's roles, and we can just knock it out of the park every single time.
Yeah. That's so powerful. And we all go through similar journeys that way. I had JV partnerships, with small properties as I built portfolios over the years. And so many years in, it's buying a big deal, realizing that it is a team approach. And then we start thinking about syndications, and, that's a whole nother animal entirely when you're trying to do a 10 or $20 million deal. Have your deals been JVs? Have you gotten into syndication? And what is your area that you like to focus on the most? Acquisitions, raising money?
Mm-hmm. Yeah. So far, I've put together a team that really fit the size of the deal each time. So the first deal, we had 3 general partners, and we had 1 capital partner because he did the whole thing. We were going to have it be a syndication, but because it was just one guy that did the whole investment, we technically did a tenant in common instead of a syndication. We did a syndication for the next 3 deals in Canyon Lake, and in Austin, and in San Antonio. And those, we had more general partners, and we had to bring on general partners that could raise a lot of capital, because the San Antonio and Austin deals were pretty high dollar. And so, as much as I've been in real estate, I haven't been building my investor database as much as some of these other people have. So luckily, yeah, bringing those capital partners on there. But, the deal in Dallas, it was 12 units. We bought that one for $850,000. So it was like $60,000 a unit. And with me selling my duplex, I didn't necessarily need the capital. Between, me and my dad, we had all the capital that we needed. So we didn't really need to raise it. And, I already had a couple of, teammates in place as far as like property managers and construction crews in Dallas. So it was kind of an easier project. So I guess it's on a case by case basis, whether it makes sense to do a JV or do a syndication or do whatever. But I would say, yeah, obviously the bigger deals they get, the more it's necessary to do a syndication.
Awesome. I've done a tenant in common into a JV myself, and my partner, my best friend growing up, had built a portfolio over the years. And I don't know, a year and a half ago, we had sold 2 properties, and the clock was ticking on a 1031 for us. And a couple people from Jake and Gino down in the Florida area found a deal, and it seemed to work perfectly. They needed a certain amount of money that we were looking to exchange, and it was a JV, and we had to structure it as a tenant in common. And it was an interesting process because it was the first time we had done anything like that. Can you tell the audience your experience with the tenant in common? And that's something new we haven't explained on this podcast.
Yeah, so a tenant in common structure is just a creative way to allow somebody to 1031 into a syndication. So it's not technically a syndication. So the rules around 1031, meaning that you need to exchange like kind property in order to avoid having to pay all the capital gains tax on your sale. So typically, if you have a $100,000 profit on a house, you would have to pay capital gains tax on that. But through 1031, you can roll that into the purchase of the next property if you're just, going up. Now, the trouble with that is if you're, selling a house and you want to come into a syndication where they, have 50 units and you want to contribute your $100,000 investment into this, $2 million capital fund. Well, the trouble is it's not necessarily like kind, because even though you're selling a house and you're buying an apartment complex, what you're technically buying is, a 5% ownership in an LLC. And then that LLC has a business plan to run this apartment complex as an owner. So it's not exactly like kind. So the IRS has a problem with being able to do a 1031 directly into that. So attorneys got together and they said, we want to fix this problem because we don't want to pay taxes. And we still want to own real estate. And we want to make this work. So they created a tenant in common structure, which basically says, instead of being part of the syndication, you technically now own 5% of this building. So if you look at the tax records or the ownership records, it will have 2 owners. It will have, syndication A LLC, and then you'll have, investor B as the other owner. And investor B will own 5%, and the syndication will own 95%. Now it gets a little tricky because the IRS says that through tenant in commons, you have to operate them separately. So if there's any profit sharing, or if there's any sharing of asset management or resources, or general partnership overrides, or preferred returns, or waterfall structures, it's technically not a tenant in common structure that can avoid the benefit of deferring your income taxes. So it's one of those structures where you do need to consult an attorney and do need to be specific about someone coming in and make sure you structure your agreement in a way that you can still retain the capital gains deferment. Because what I've heard can happen is that the IRS can audit your tax returns, and then even though this was set up as a tenant in common with a 1031, if it's evidence that you're paying out waterfall structures or any other sharing of resources, the IRS could tax you with capital gains on your original sale and invalidate your 1031. So it is a little bit of a tricky subject, but it can be very beneficial if done the right way.
That was a great explanation. You hear a lot of uncertainty in the industry on 1031ing into a syndication. Your company, Top Producer Investment Capital, sounds like it's a little bit of a new venture. Tell us about your plans for this company after your recent year of snowballing with success.
Yeah, absolutely. So my holding company is Razzan Properties, and that's kind of what I've been using as my flagship company so far to get started in this business, and it's great. But as you go about the business and learn these things, I've had to tap into, well, what's my real role in this entire business? What's my unique value proposition? Who am I serving? Like, why am I doing this business other than just myself or to make money, which are great goals, but I'd like for it to mean something more than that. And what really struck me as a loan officer is that I never really even knew syndications existed, or else I probably would have started doing this a lot sooner. And I was doing my career for 6-7 years before I finally found out that these were out there. And they're extremely beneficial to realtors and loan officers specifically, because those are people that understand the benefits of real estate. They see it every day, and they own their investment properties because they know how powerful it is. But just the same problem that I was explaining earlier, where I didn't have the time to really make a good investment business that I was always getting, kind of bottom tier investments, and they were doing okay, but my time was better spent maxing out my commission structure and getting more leads in the pipeline to close more mortgage loans and hiring assistants and building a mortgage company, because I could make more income that way. And then if I would take all that capital and funnel it into a truly passive investment, instead of, trying to find a single family house that was a good investment and then manage a renovation crew and then have a property manager that technically manages it, but you always got to watch over their shoulder and make sure they're not overspending and make sure that they're actually screening tenants in a way that you would screen them. And, not everyone even, has the time to understand market dynamics of, well, where is the appreciation going in certain areas of town? And, where are the rental rates and where's the path of progress? And that's a lot of market dynamics that an investor should know, but doesn't really make sense for, a mortgage loan officer or a realtor to know, because their best use is saying, hey, realtors probably should know that kind of stuff, but still their best use is getting new clients, helping them buy their home, and then closing. So Top Producer Investment Capital is my new venture to really help those people max out their time. And it could go towards anyone who's a top producer, like business owners or entrepreneurs. But really people that understand real estate and understand the value. When I can tell them, hey, we bought these cabins at, $137 a door, all in with closing costs and renovations, they're at $200 a unit, when normally it'd be $500 a unit to buy a similar property as a short-term rental. And here's the profit that we're going to take from these, and here's our mortgage payment, and here's our expenses. Loan officers and realtors immediately get that. It clicks for them, and they're like, great, I get it. I never would have been able to find this deal on my own, because I've had to go through about 150 bad opportunities before I find the one investment each time that I want to put my name behind and say, yes, this is the one that I believe there's opportunity in. And you can't do that if you have a full-time job to really, really find the one needle in the haystack. So that's my value to kind of bring to the community, to say, hey, if you're a top producer, if you understand how real estate works, if you want to, double your net worth in 5 years, if you want to get generational wealth and truly passive income without overlooking your shoulder, this is the way to do it. So you can max out your business and your lifestyle, as a realtor, as a loan officer.
Wow. From this episode, Stephen, the one word, and we've talked about this, he explained it in several different components here, is focus. When he first started in mortgages, he didn't just jump right into being an investor. He was focused on his job. He had to make some money. And then when he realized that there's so much potential as an investor, success leaves clues. So he's seeing his mentor doing it. He's seeing his clients doing it. And when he was ready, he jumped in and did very, very well on those small properties. Then that 14-unit short-term rental. You talked to 40 banks, 37 of them just said no, but you had that focus and tenacity. You knew you had a powerful vision for that property. And now you're continuing in that top producer where you're focusing on just one or two things, and the power of focus. Knowing that you were in film and all of that leading into real estate, the only thing I could think of leading up to this was I just followed you on LinkedIn. And are you starting to, or are you using some of that film experience to market yourself on social media?
Yeah, so I have a virtual assistant that helps edit a lot of the videos that I do, and I do hire film crews to come with me on some of these projects that we're doing, so I can help explain the story to investors of each deal that we do, why we bought it, why it's a good deal, how we're going to renovate it, see the before and after, see the construction. So, even though I'm not doing the day-to-day production of, holding the camera, doing the editing myself, I understand how the process works, and I understand the benefit of it, because as humans, we learn best through stories, and videos are the best way to communicate your stories. If you look at any other GPs, how are you really going to say what's a good investment? You can look at their website, you can look at their photo, you can read their bio, but how do you really know them? How do you trust them? How do you see what they've done, and how do you hear their reviews? Is, you got to tell the story of each deal. If I were to tell you, hey, this deal's a 17 IRR, or that one's a 21 IRR, you're like, well, yeah, but really, how do I know that? So people trust and understand by story. So my vision and my background in film has helped me be able to craft the stories for each of these deals that we do, and help me have a good narrative out there so that people can get behind the movement that we're doing.
Stephen, you got some interesting stories on your big deal. You know, we got to tell that story eventually.
Yeah, you learn from stories as well, whether they're your
Absolutely.
own or someone else's.
Yep.
No doubt. The reason I say that we're poking along on social media and trying to tell these stories, but now you explained it so well, and it comes to mind. I know the power of telling that story, but on a day-to-day basis, creating content and really just staying focused on, okay, what's the best way to take my story or our stories on each particular investment and create good content so people are able to follow your journey is kind of like that tenant in common. It's threading that needle. Ryan, this is the Collecting Real Estate podcast. They say you have to have 3 of something to make a collection. So we have 3 questions for you to wrap this up. Number 1, in 5 words or less, what is the most important thing you've learned since you started collecting real estate?
Yeah, absolutely. It would be, don't be short-sighted. Now, I usually speak in the affirmative, so I could say like, you should be long-sighted or have goals or visions, but people confuse the message to think that, hey, I should just have a good business plan or a vision board. And the trouble with that is everyone wants the Ferrari. Everyone wants to be a billionaire. Everyone wants all these things, so that's not really going to differentiate yourself. A lot of people are short-sighted and greedy in the sense that they want to do things very quickly to make a quick profit or to get the edge or, do a negotiation that really favors them when it might break a relationship or close the door to future opportunities. So by having a long-term vision, for what your business plan is going to be well into the future, you've got to work to establish good relationships with people, and you've got to work to always position yourself in a place of growth, and not worry about money and not worry about little deals here or there. It's about build a foundation, building the relationships, and then eventually you're going to make money from places that you never expected, because everyone's just going to have a lot of value and growth in you. That opportunity is going to find you.
I love that. Building bridges, not closing doors. Number 2, what are your 1 to 2 year personal goals?
Yeah. So, from a business perspective, I'm actually, launching the Top Producer Investment Capital. I've got a website, that's in the works, and I'd love to get some ads going out there and get some automation to have, hopefully 4 or 5 investor calls a week so we can onboard a lot of new investors and show them what we're doing. In the next couple of years, I need a team that can help me. Right now, I have 1 assistant and I have some general partners that I work with, but I'd love to hire a full-time acquisitions assistant and a full-time investor assistant in the next 2 years. And then that way we can really have a full business instead of just me, wearing all these hats and doing every part of the process. And luckily I've had great partners along the way that I've shared with that. And I think, if I have those resources, we can all grow as partners together much quicker.
When's the next party at the short-term rental property? That's what I want to know.
It's great. So yeah, we actually are about 70% of the way done with the first 2 cabins. We have 2 vacant right now that we're working on simultaneously. So I would say early January is when we expect them to be online, fully furnished, fully ready to go. And then in January, we're going to have the next 2 vacants that we're going to start renovating as well. So it'll probably be, I would say October until all 14 are online. But we're starting plans to do the pool construction and the outdoor kitchen construction. That'll be ready probably in June. So I'd say to really max it out, the summertime coming up is going to be the best time to get out there.
It's exciting.
Absolutely. Jeez, I definitely want to go check that out for sure. What about you, Stephen?
Yeah, we're both big fans of Austin.
No.
It's a fun town.
How can we and the listeners assist you? How do we contact you?
Yeah, so I'm most active on my Facebook and Instagram pages. Right now, it's just Razzan Properties, so at Razzan_Properties. And you can see all the projects that we're working on. I'm very quick to respond to messages on there. And that's the best way to stay connected.
Awesome. It's great having you on, Ryan. I really appreciate it.
All right. Thank you, guys.
Thanks, Ryan.